Hello everyone, a very good evening. You're watching The Money Show on ET Now, and ET Now's Rise with India Prime Time segment. I'm Mubina Kapasi, and the show as always is dedicated to making you smarter with your money, educating you well, making you sound financially, and of course not to mention helping you spend as well very wisely. Well, today we are going to be talking about the big fall seen in the markets, but also on the ramifications that have come by because of the Yes Bank fallout. I'm sure many of you are wondering what exactly is the impact on my mutual fund, be it an equity mutual fund or a debt mutual fund. Well, I'm going to be joined by none other than Kaustubh Belapurkar of Morningstar India to talk about that. And later on the show, we are going to have a bit of a postponed Women's Day celebration. Very interesting programming lined up, so stay tuned for all of that. But before I do any of that, like I mentioned, big fall seen in the market. Today itself, we saw the Nifty 50 cracking almost 400 points. It's been the biggest crash that we have seen in a very long time. In market capitalization itself, the Nifty has fallen 4 lakh crore rupees. The Nifty Bank, in fact, is in what we call as the bear territory, which means it's fallen 20% from its recent highs, and it's the biggest percentage fall since almost 2015 for a lot of the indices, the Nifty mid-cap as well. Small cap index as well has cracked the most since Feb 2018 on a percentage basis. And you know, this sell-off is not limited only to the equity markets. The bond markets as well have cracked. The 10-year bond yield, in fact, as we have it just in, has closed at the lowest since 2009. That's roughly the global financial crisis era. Oil prices, we know, has fallen a good 30%, though mind you, that may just still be good news for India. But I suppose the topic we want to talk about today is obviously Yes Bank and the big fallout that has taken place. Equity mutual funds obviously have been seeing pain because of the Yes Bank exposure, the big fall that the stock has seen. But now, of course, with the entire AT1's bonds bid resurfacing, it is something that's going to lead to debt mutual funds as well see a big crack. Now, I'm sure many of you guys, especially in the debt funds, may be a bit perplexed. Hence, we have an expert voice on the show, Mr. Kaustubh Belapurkar of Morningstar India. He joins us right here in our studios. Kaustubh, thank you so much for taking out time. It's an extremely important topic. And you know, a lot of our viewers watching obviously have this one question, right? That, look, I thankfully don't have maybe a Yes Bank savings account, current account, FD, but you know what? I do have mutual funds, and that mutual fund may in turn be invested in Yes Bank, especially if you're one of those ETFs, right? You've literally invested in the Nifty 50. It's a passive fund, so you obviously do have a little bit of Yes Bank. So folks, even if you don't have bank accounts in Yes Bank, you are still impacted, right? These are, by the way, some of the debt funds as well that we've exposed, in fact, that are exposed to. We've taken this information from Morningstar itself, and look at the sort of crack we've seen. On 5th March, there was a decline, and you know, between the period of 5th and 6th March, the decline was even more severe. So let's start off first with the equity mutual funds bit. Which are the funds that have actually got the most amount of exposure to Yes Bank First Equity?
Sure. So if you look at the equity side, right, so like you said, so it's a part of a couple of indices, the Nifty 50, you know, the private bank Nifty, the banking sort of Nifty. So obviously there's been exposure there. But I mean, the heartening news is that, you know, the exposure with the overall index was kind of sub 1% in that sense. So obviously, with the index funds, you know, those funds would be holding less than 1%. So in terms of that, the overall impact to your portfolio is not that large. I mean, in the greater scheme of things, right? I mean, there have obviously been some actively managed funds that have also held Yes Bank from the HDFC and the Franklin stable. But again, their limited exposure, typically less than 1%. So I'm not completely perturbed or worried excessively about the exposure there because it's fairly limited. I mean, an equity fund, you know, even if you say were to wipe out essentially the entire 1%, that's a 1% loss on your portfolio, which is not dramatic from an equity fund or a, investor's perspective, really.
So for equity funds, any which ways, you're usually long-term investors,
That's right.
you know. So, I mean, such events really, it may just impact your NAV here and there, but you know, if you're a long-term investor, you're really not going to sell exactly when the NAV has gone down by that one or two or however it's been hit. So maybe not so much so for an equity MF investor. But you know, again, Kaustubh, it sort of begets the question that, that means every time I buy a mutual fund, should I actually be poking my nose around as to which stock has this particular mutual fund invested in? I mean, how closely should I be looking at how the manager is managing the mutual fund? Is that really something you think that retail investors should be poking around into?
So honestly, no, because I think then you're kind of second guessing the manager in that sense. So I mean, I think you have to give faith. I mean, we've got some really good, exceptional managers there, and obviously, if this is kind of almost an unexpected sort of, in that sense, an event which is not something that would happen every day, right? I mean, this is something which is huge in that sense. So like I said, the exposure was fairly limited. Obviously, it's kind of hit the broader markets, but long-term equity investors shouldn't be too perturbed.
Okay.
The good long-term equity funds which have delivered returns will continue to do so. Obviously, the great managers, I mean, it's just a temporary blip, so to speak. So I wouldn't really be worried too much. Leave it to your advisor, leave it to the fund manager to pick the funds and the stocks in your portfolio.
So it's not a cause of concern. It's not a reason why you should redeem the fund. And also, don't second guess the fund manager, because then you should just not give money in the first place. The whole point of having a mutual fund is that you're entrusting your money to somebody who's more experienced, smarter than you, at least when it comes to investing in the stock market. So, there's really no point of doing all of that. But I suppose when it comes to debt mutual funds, in fact, we just saw that, right, on our screens, and I'll request my producer to pull that up as well. There was a drastic fall in the NAV of debt mutual funds, and I think that is something that would be a bit perturbing, because cost of debt MFs are usually for that shorter term time period, 1 year, 3, or maybe at the most 3 years. And look at that, you have a 9.5% decline in the Nippon India equity hybrid. Credit risk as well took a 12% decline, and we haven't accounted for today's fall, if there is any. So what would you recommend? I mean, well, firstly, let's talk about these debt funds that have this high exposure to ES.
So I think, it's very important, and what's been happening that we've been reeling under this whole debt sort of crisis for the last 18 to 20 months almost, since ILFS kind of broke out. And there've been a series of sort of sentimentally, it's really hit. And, obviously there've been downgrades, there've been write-downs. So that's really perturbed investors, and you can see that in the way the people have reacted. Where they've kind of moved away from the credit risk category or the medium duration category, where there were funds that would hold lower rated credits in their portfolio, right? And they've kind of migrated to what we would call the slightly more safer sort of categories, be a banking or PSU, or a corporate bond fund where the mandate itself necessitates the manager holds 85% plus in AA plus and
higher
sort of
security,
so high rated security. So they've kind of moved away to that. But in terms of what's really happened with this, right? So I mean, clearly a little unprecedented again. I mean, I think this is the first that I've seen in my career that I mean, there've been 81 bond issuances that have happened. They've been called by banks. So it's been business as usual. But and what we've learned through our careers that equity takes the first hit, and then so obviously here, I mean, I'm not going to get into the legal perspective of things, but in that sense it's a little unprecedented. So which has kind of worried investors, and the impact has been dramatic, right? So Nippon obviously wrote down the value to zero on day one. So in that sense, the NAV impacts already happened. All the other fund houses have followed suit on 6th of March. So in that sense, the security has already been marked down to zero. So your NAV has already been impacted to the extent that it could be. So there will not be any more impact of Yes Bank. Now we'll see what happens around the draft resolution proposes that the 81 bonds are written down permanently. But let's see, I mean, if there's any sort of back and forth that happens, and they could potentially maybe be converted to equity or things like that. So that's something, and I won't comment on because I'm not the expert, but those have also been moved into segregated portfolios that have been created. So now as an investor, if I think about it, the pain has happened in the NAV, it's already fallen, it's moved to a segregated part of the portfolio.
Side pocket.
The side pocket, that's right. So if I want to sell, one thing I would want to do is just relook at that fund from the perspective of my own risk appetite. Because a lot of the funds that are holding it were kind of credit risk funds. Because the one thing to acknowledge that these were kind of hybrid instruments, and they were rated lower than the Basel II Tier 2 bonds of Yes Bank or any other bank for that matter, right? So clearly there was risk in them. But like I said, there's never been an incident of them being written off, right? So in that sense, they were in credit. A lot of them were in credit risk portfolios or portfolios that take credit risk. But now, for an investor, he needs to kind of think about that: is that the most suitable portfolio from my perspective? I mean, I would say that someone who understands credit risk and is okay to kind of take that pain because I can potentially make a high yield. That's fine. Because a lot of investors, I suspect, just looked at the returns, looked at the yields and came in. And now are kind of waking up to the fact that credit risk does exist. So if that's the case, then the pain's already happened. But if it's never too late to kind of cut losses and say, look, let me get out of it if this fund's not suitable for me. Because the environment has been such that we think, okay, now things are turning around, but there have been cases. There could be, I don't know. There could be other cases around.
More cases
so if you think that it's not suitable for you, best is to kind of move to, like I said, a corporate bond fund or a banking or a PSU fund.
Yeah, I think, like you mentioned, it started with ILNFS, then it went on to DHFL, a bit of Vodafone Idea as well thrown into the mix, and now Yes Bank. But I suppose you could look at it this way as well, right? That I think future issuances of such bonds will definitely carry a higher interest rate. I think I won't be surprised about that. So along with a greater risk will also come greater returns, I suppose. But again, the environment, I suppose, right now is not exactly conducive for the same. Right. So Kaustubh, for all of our viewers who are watching and who may be owning one of these funds where the NAV has already accounted for zero, as the value of the Yes Bank bonds, do you recommend then, let's say if they don't need the money right now, they are okay with the risk appetite right now they have, do you think that they should practice a little more patience because they've already accounted for the worst? So whatever could happen, it could only go up. Do you think that they should?
Yeah, absolutely. So if your risk appetite still allows you, because like I said, fundamentally the construction of the fund itself is to carry credit risk in it, right? Yeah. So if you're okay with that, stay the course.
Okay.
And if by chance there's some resolution and the segregated portfolio kind of gives you some returns, then that's like a bonus. But right now, go with the thought that, okay, this is what my primary fund's going to be. If I'm okay to take the risk, I stay put. If I think that's not something which I can live with, then maybe you want to move to another sort of fund category.
Okay, all right. So equity MFs, stay put, debt MFs as well. If your risk appetite allows you, you could consider staying put because the worst has already been done. And if you had to sell out, you should have probably sold out on the 4th or the 5th March. But again, nobody can time that, right? Especially when you've got a side profession or a side business going on, you're really not going to track every news piece in the market. Okay, Kaustubh, we spoke about a particular action that mutual fund houses take, and that's side pocketing. Right. I didn't realize many of our viewers may not be actually aware of this action. So what exactly does it mean, and when do mutual fund houses do this? What does it mean for our investors' NAV?
Sure. So side pocketing is something which was enabled sometime last year, where basically what SEBI said was that because of the stress in the credit markets, if and when there is a downgrade event and the rating of the bond actually goes to below investment grade, you can create a side pocket in your fund and move that instrument to that. Because essentially, we know that our debt markets are pretty shallow in terms of liquidity. So, if you were to kind of mark down that bond and it stayed within the main portfolio, if there are redemptions that would happen, that the investor wouldn't get out and he would never get back, the hit that's already happened on the capital. And B, what would happen is that, he will have to sell off the good rated bonds to kind of make good the redemption requests. So right now, because of the side pocket, the rest of the main portfolio can function as is, because the side pocket, the downgraded security has already been moved there. Whereas the main portfolio should continue business as usual as long as there are no other issues with that.
Okay, all right. I think we have a live caller with us right now on the show. And let me remind all our viewers as well, if you have any questions or queries on, mutual funds, on the impact that Yes Bank could have on your debt or equity mutual fund, if you still have any queries, Kaustubh is right here. The number is appearing on the top of your screens. We have Srinivas from Bengaluru who's joining us on the phone line. Srinivas, good evening. What's your query today?
Good evening, Mobina. I have two questions to Kaustubh.
Yes.
These questions are not on Yes Bank, but general questions on mutual fund I wanted to ask to Kaustubh only.
Okay.
Now I have two questions, Mr. Kaustubh. One is on the Morningstar rating only. Now recently you have differentiated between the growth and direct options in terms of ratings, gold, bronze, and then silver rating. Why is that? Because the only difference is the expense ratio, as far as I know.
Yes,
so why did you differentiate between the gold and regular and direct plans? That is first question. Second question is, I've been doing research on mutual funds since from 4-5 years. I came to know from the research that the one fund which has, both funds have started in the same year, same month. One fund which has given returns of 14.2%. Other fund has given a return of 15.76% in 10 years. But the NAV of the fund which has given higher return is less compared to the other one which has given lower return. Why is that? Is there any problem with declaring the NAV, or is there any hidden this thing like that problem?
Okay. Kaustubh?
So let me just quickly, while I won't really delve into too much details of the first question,
Sure.
maybe I can take that offline. But really, when we're coming from a Morningstar perspective, when we're putting out ratings, the idea is to, which are the funds that can deliver alpha over the long term going forward.
Okay.
And clearly, one of the things that we look at is, in terms of expenses globally, that's become a huge debate.
Yeah,
In terms of, so obviously a direct plan in that sense, while all else being equal, obviously a direct plan will be cheaper than a regular plan, and that's where potentially the rating could be different. But again, this is not a call to say that direct is always necessarily the way to go, because if you don't understand what kind of funds you want to get into, you obviously want to use the services of an advisor or a distributor. But obviously as things stand up, a direct plan will tend to deliver better alpha or returns than a growth plan. Srinivas, to your second question, in terms of, did you say the NAV in terms of two funds launched on the same day, the same fund? Could you just come with the second question?
Do we have
January 2005, in 10 years, one fund has given higher returns in terms of percentage of returns, other one has given lower returns. But the fund which has given higher returns, the NAV of that fund is far less when compared to the other one. How can it be?
Yeah. So, the point is, Srinivas, I don't know which two funds you're particularly talking about, but obviously it depends on the time these funds were kind of launched. And if you're talking about 10 years since 2005, obviously we've already moved beyond that. So, I mean, I don't know what the period between 2005 to 10 in terms of the returns of the two funds were. So, obviously,
at the same time.
Sorry?
It was launched at the same date.
They were launched at the same time, but you're looking
saying,
at 10-year returns, right? I mean,
Yeah.
potentially you would want to look at 15-year returns if they were the same or not. So, I mean,
Yeah.
if you're making a comparison, because 10-year returns is from 2010 onwards. So we don't know what's the history on the 2005 to 10 period. So I think that's important to kind of get the entire picture before we can make a comment.
No, and also I think what I suppose, I don't know if I've got his question right, but he's wondering about why the two funds launched at the same date and time. Why are the NAVs different, even though one has actually delivered higher returns than the other?
Correct.
But again, it's also on the constituents, right, of the fund. I mean, depending on how the values, etc., have moved. So I suppose it also depends on that. And yeah, adding on also to what Kaustubh mentioned, Srinivas. But I think to talk about this, it'll take a really long time, so we can take this question offline. Let's take on board our next query. Dilip from Amritsar has sent in, has actually got a question for us, and he's joining us on the phone line right now. Hi, Dilip. Good evening. What's your query?
Hello, ma'am. My name is not Dilip. I'm Gurmeet from Amritsar, ma'am.
Apologies, Gurmeet. Go ahead with your query.
Ma'am, my question is on money market funds, ma'am. They invest in CPs and CDs.
Okay.
Are they safe or as risky as debt funds?
Are they safe or as liquid as debt funds? That's your
Not
question.
as risky as debt funds, ma'am.
Okay, so you want to know basically about money market funds, is that right?
Yeah.
Okay,
Yeah,
so
ma'am, they invest in CPs and CDs, ma'am.
Yeah.
Should we switch from low duration to these funds or not, ma'am?
okay, fair point.
Yeah, so I think largely again we'll need to. I mean, traditionally most of the CPCDs, with barring a few exceptions, have been the highest rated sort of
Exactly.
A1 plus or
Yes.
equivalent. So in that sense, they're obviously reasonably safe. But I think the prudent thing for all of us to do is just quickly look at what we call the style box or the underlying portfolio breakdown. Even if you're a retail investor, it doesn't harm to just pick up the fact sheet and look at the rating breakup of any fund that you look to invest into. I think that's a practice that all of us should inculcate, even if you don't necessarily understand. But I mean, the basic terminology, the better rating, the lesser
higher the
probability.
rating, the
I mean,
better.
while that's been broken in the last 18 months, but there's still the probability of that happening is lower. So I think, Gurmeet, money market generally reasonably safe. Obviously, within the low duration space, again, you have funds that do take on a higher credit risk. So I think, like I said, you need to, before getting into investing in a fund, just look at the underlying credit breakup of the fund. It doesn't really take too long, and it'll just be beneficial. So you know what you're kind of getting into.
Okay, all right. So yes, that's of course about the money market fund, and and I suppose sometimes in these debt funds, the pecking order of the funds as well becomes a bit complicated. Since I have you, Kaustubh, I would like to talk to you also about that flash appearing on our screens, and that's the bond yield. I mean, along with equities, we are also seeing a big gash in bond yields. In such an environment, especially for all our retail investors who, the more savvier ones usually just take out money from their savings account and park it in these liquid funds, the shorter duration funds. In this environment of this low bond yields, where do you suggest what category of debt funds would you recommend they could park?
So I think for most people who are kind of risk averse, I would still say go with corporate bond funds. I know the yields are pretty I mean,
Low.
depressed right now, but corporate bond funds, short duration funds with reasonably clean portfolios. Again, like I said, just look at the credit breakup, AAA, sort of large part AAA, are the funds that I would get into. Because, the interest rate sort of, I mean, they've kind of moved down, but you don't want to be betting on interest rates right now from a retail investor perspective, because, timing becomes kind of, so I would say stick to the, the short to the medium end of the curve. Like I said, the corporate bond and the short duration should be a reasonably good sort of space to get into.
We always tell our retail investors, don't try to time the market. You never know what's going to break out. Like you mentioned, this was completely unprecedented. I mean, usually it's the equity guys that take the hit, but this time around, what happened. But thank you so much, Kaustubh. Words of advice coming in from Kaustubh, of course, whether you're an equity fund holder or debt fund holder, and if you have exposure to yes, the worst has already been done, and you do not sell when your funds or your assets are at a low, you sell them when they're a high. So if you have the risk appetite for your debt mutual fund, just stay put, stay a bit patient. You never know if things turn around, if the yes-back administrator proves to be an able administrator. You never know, there may be some sort of solution found for those bonds as well. Fingers crossed for now. But thank you, Kaustubh, once again for joining in. We will take a very short break. Don't go anywhere.